So hello everyone, welcome to this webinar on operational TP in the pharma sector. We're just going to give a minute or so to let people join and then we'll kick off properly. So thank you very much in the meantime for joining. So I can see we've got a fair number joined already now. So and we're 1 minute in. So let's start with the introductions anyway. Hello again. My name is Paul Sutton, and welcome everyone to this webinar on operational transfer pricing, specifically for the pharma sector. I'd like to introduce our two experts today. So we've got Philippe Palmier and Michael Stanhope. Philippe, can I ask you to introduce yourself in a couple of lines, please?
Sure. So I've been working on transfer pricing for the last 20 years or so, mainly as an in-house advisor. I was the global head of a big pharma company for 10 years, and prior just setting my own individual practice like a year and a half ago.
Great, thank you. And Michael, I guess you're our resident rocket scientist when it comes to the technical stuff. So perhaps you could introduce yourself as well, please.
Yeah, thanks, Paul. I was a physicist in a former life, so you're half right on that one. So I'm technical director at Price Consulting. I'm in charge of implementing finance and tax systems, basically, and a large amount of what we do around tax is actually in transfer pricing. So I'm working at the moment on a large transfer pricing project for a pharma company, and I've worked on transfer pricing projects in other sectors as well prior to that. So here to talk about putting these systems in and TP automation in a pharma context.
Fantastic. And just to introduce myself, my name is Paul Sutton. I'm one of the founders of LCN Legal, and we specialize in helping multinational groups to have tax audit ready intercompany agreements which actually support their TP as opposed to undermining and contradicting their TP policies. That's our role in life. So the general format for today, or rather the agenda, we're going to start off and ask Philippe to really set the scene in terms of the specific challenges faced by the pharma sector in relation to TP management. Obviously, it's his home subject, as it were. So we'll use that to set the scene. I will then speak for a bit about the legal implementation of transfer pricing from a high-level perspective, but focusing on what are the key things that make a difference. And then we'll ask Michael to walk us through really an automation solution as it applies specifically to the pharma sector. And then hopefully in terms of the bulk of the session, we'll have some time to talk about FAQs and any specific questions that you may have. So that's really what we're planning to cover in this session. In terms of housekeeping, we will try to keep to 1 hour. So if anyone has any specific issues that they want to raise afterwards, then please just feel free to reach out. But more importantly, please do participate. So that means using the chat function of this webinar platform to ask questions as we go along, and specifically to raise challenges and all the awkward stuff that we really need to get into. And we will have a couple of polling questions a little bit later, so please do participate and give us your feedback as we go. So with that, I'm going to ask Philippe, please, to set the scene.
Sure, thanks, Paul. I think the overall, I think most people attending would know this pretty much, right? I mean, but the general environment is quite simple. We have a changing landscape with reinforced need for consistency. Why consistency decreased? Because the three-level layer, three-layered approach of the OECD in terms of documentation has created that increasing pressure on consistency when it comes to transfer pricing and tax data in general, especially when you combine this with the multiple and increasing number of tax forms. So more than ever on transfer pricing, the game is about doing the right thing, meaning having sensible policies, but also doing things right, because more and more evidence is going to be requested from tax administrations to provide evidence basically that we are reflecting in the accounts what the intent of the policy was, to limit a bit the issue of doing an audit on the policy itself. The second part is, of course, and this is not new, not specific to pharma, it's a more general remark, is about data management. Why? Because, well, every single transfer pricing person I know complains all day long that data is never in the right format for TP purposes. And, well, guess what? It's right. Moreover, the cycles of finance, the finance cycles, for example, the reporting cycles are getting shorter and shorter, meaning that we begin to have in some companies data available, already available data, actionable data by the end of October, the end of November, with 17 versions of budgets and 17 versions of forecasts, which makes basically manual processes a little bit less handy or less feasible than it was before. The other problem that companies usually face is that there's no single ownership of transfer pricing master data in most companies I know. Is automation gonna solve that? Definitely not, but it's gonna trigger a tremendous thinking around transfer pricing master data. So this is one of the basically embedded benefits that we see there. Can we move to the next slide, please? Trying to make this short. So, well, when it comes to operational transfer pricing, I tend to believe that there's basically 3 dimensions to see how important it can be within a firm, which is, of course, the level of margin that is allocated to, or that transfer prices allocate, the geographical footprint, and the footprint in terms of intangibles, because that's going to basically tell you what kind of transactions you're going to be dealing with. And finally, but not the least for sure, is volume and granularity of transactions. Of course, you have all other elements that you need to consider when you're designing your operational transfer pricing processes, which is the audit exposure, the intensity of your M&A, meaning how often are you going to be integrating businesses within your operational frameworks structure, or the diversity of the functions that you have. In those terms, I would tend to believe, and pretty convinced of it after those 20 years, that pharma has the perfect transactional storm. Why? Because when you think about distribution transfer prices, which is like market transfer prices, they're heavily loaded with intellectual property revenues. So there's a tremendous amount of upstream margin that is embedded in those prices, generating all kinds of complexity on all kinds of issues that can be related to margin allocation, financial aspects of margin allocation beyond transfer pricing and beyond tax, and customs, of course. As we all know, pharma is one of the most R&D intensive industries in the world, and it's one of the most regulated industries of the world. We'll see later on that tends to have an impact. One of the less obvious aspects of pharma is that because of those regulations, it requires a tremendous amount of global infrastructures, global marketing structures, global market access structures, meaning that the rate you tend to have in the pharma industry of, let's say, non-allocated functions to the business or to the BUs tends to be extremely high compared to other businesses. There's, of course, the extreme geographical footprint of many pharma companies, which are present basically everywhere. And digitalization is not drastically going to change that, but for, let's say, consumer healthcare, probably. The pharma supply chains tend to be sequential from manufacturing to markets and multi-hopping, meaning that that's going to be a tremendous multiplicator of transactions compared to some industries that have, let's say, a simpler approach of manufacturing. We're seeing very clear examples during the COVID crisis on the complexity of that supply chain between the manufacturing of the active substance and, of course, fill and pack and any other intermediate activities. The last aspect on pharma, on this global meaning that which makes it very special, is pharma has been growing. Big pharma has been growing basically by mergers and acquisitions, and that means integrations. stating the obvious, right? But when you have an operating model that works and that generates acceptable results, it makes it much easier to adapt or to bring in a new franchise within the entire structure. The integrations can be painful, can last for a significant amount of time because all elements of the value chain do not integrate at the same speed. So sometimes it's not unusual for integrations to last 2 or 3 years. There's now on the more practical side, there's a high number of commercial references in pharma. There's a tremendous number of SKUs, references that are made by country for one given product with one given dosage. There's a sequential production line. I think that we clearly already discussed. There tends to be, because of this M&A activity, a tremendous amount of IP owners. And while businesses usually don't care about IP owners, probably legal and tax are the only functions really paying attention to what it means. It just triggers some complexities in the management of the flows. Finally, and this is clearly an element that is a challenge for both transfer pricing policy aspects, but also for management of practical operational transfer pricing, is the collaborative approach of R&D structures. R&D used to be very sequential in the pharma industry, and all the business model has been basically disrupted over the last 10 years, if you're lucky, to have more collaborative approaches with incremental and technological approaches to R&D, which makes basically tracking the R&D costs definitely a challenge. Next. So what are we talking about? What is it so complicated at the end of the day? Well, people tend to forget, luckily we're being reminded of it now, that, well, supply rules in pharma. It's not just another product. It's a product that needs to be delivered to a patient. So there's a tremendous interaction between supply chain, usually, and operational transfer pricing, because the transfer price is just a commodity for the supply chain. And the supply chain has very stringent constraints. Markets in pharma are changing drastically over the last, I've been in that industry for 20 years. And over 20 years, you have basically, I do remember, for example, in a long time ago period, where basically most actuals were meeting budgets for a tremendous amount of countries. Now what we have, because of the increased pricing pressure, the increased competition, generic penetration, you of course tend to have much more noise on that curve, which triggers the immediate impact of, well, you need to basically review your transfer prices more often, and you need to adjust them basically permanently. That's the hectic part of operational transfer pricing. Now, IP boxes is definitely something, is a little bit of the sweetheart of the pharmaceutical industry because of the importance of the R&D and the IP in the industry. But IP boxes have been changing a lot, obviously, triggered by the BEPS works on the last decade, which basically generated the Nexus framework. And I think Michael, you can talk about it, because it's definitely one of the biggest constraints on data tracking to produce enough evidence on Nexus for the IP box management, which is just an additional layer of complexity. Of course, as we're saying, many BUs, many IP owners, one product, or let's say zillion products, and that segmentation doesn't often match for transfer pricing purposes as it does for operations. So there's a recombination, there's a data cube there to be managed to realign a little bit the data to the format we want. Customs is probably the most disregarded but most important problem that TP practitioners in the industry face. Why? And we'll come to this a little bit later. It's just simply because customs looks at transfer pricing in a way that we TP people don't look at it, on a tremendous granular SKU level, which is not the way you set your policies most of the time. Regulations are important in the industry as well, because you can have several markets around the world with either different policies, different regulated margins, levels of margins you can make depending on typology of products, depending on the countries as well. So can we still deal with all that on manual processes? Well, the answer is yes, but you would need just like very large resource and extreme skills. because that's where automation kicks in. And automation, I think we had this debate during the preparation call with Michael. I mean, automation can mean a lot of things. Can mean standardization, can mean processes. But I think it's important for everybody here to realize that automation goes well beyond just the tool. It's about the organization. It's about the most important part for me. It's about governance. Is who's going to be responsible, who's going to be enacting, who's going to be using, and who's going to be producing this transfer pricing data. Why? Because all this automation is going to allow you to basically make your processes, of course, much more efficient, but to gain control. To gain control in basically to be able to produce accurate dashboards, accurate data for your management, to have a more lean management of all the tax function. Of course, this goes hand in hand with agility, and agility is going to be about all the operating model and how your operating model is going to basically allow all the operational transfer pricing to be efficient. Then there's the most important part of automation, which is going to be the user journey. Not only the TP user, but actually everybody else outside your transfer pricing organization. How do you make their life simpler? And of course, when it comes to your own assets, which is people, it's going to be about asset utilization, which is two little things, two little different aspects, which is, of course, upskilling. The time you're not spending doing operational transfer pricing on Excel, you're going to do it analyzing something else and bring in value. And the last part is of automation here that articulates your organizations is also how do you work within a globalized tax function or globalized transfer pricing team and shared services centers or specific centers of excellence. So again, as everything in automation is going to be about people, processes, and technology. And I think one of the major challenges that pharma companies or any company faces when it comes to automation is about change management.
Sure. Just wanted to jump in there, Philippe, if that's okay. So you mentioned about the frequency of changing or updating TP policies. What kind of frequency are you looking at in your experience in the pharma sector?
Well, I mean, everybody has its own opinion there, but you obviously with the current context, you're probably looking at, of course, setting your prices every year, almost on a global basis. You're going to be looking at making maybe a mid-year adjustment if necessary, and at the end, probably an end-of-the-year adjustment at the very least, and more likely than not, an adjustment on actuals where that is possible. So you're looking effectively at the minimum, let's say, or 2 or 3 shots at your transfer prices. And people would say, well, if you're changing those transfer prices so often, it's just like, why don't you just look at the end and that's it? Well, that's where the financial aspects of transfer pricing kick in, because there's a smooth way of allocating your margin and there's a violent way of doing it. A violent way is just not revising your prices, coming at the end of the year or the year after and just making huge adjustments. That's going to bring you exposure. It's going to bring you basically a lot of explanations to make to your audit committee and to your external auditors. So it's going to be a little bit of a hamper your credibility for transfer pricing control.
Sure. And I guess there are other factors like customs issues as well, because that needs to be managed in real time as well.
Yeah, exactly. I mean, I'm not a fan of real-time management, but at least every 6 months is good to take a look at what's happening.
Sure.
Yeah.
Maybe we can just move. Oh, sorry.
Just to jump in on that one, yes, I've seen it done kind of, I suppose, 6 times over the course of the year as well. So say one price setting exercise done in advance, based purely off forecasts, and then up to 4 times within the year, and then a true up as well. And that price setting based on forecasts is actually what we'll talk about in a demo later as well.
Perfect. So let's bump just into the into just brief points on 3 main processes that we have here for the pharma industry, which is idea to product, the R&D, right? The problem with R&D that every TP practitioner has always faced is that operations are really at best agnostic to the notion of IP owner. So that triggers the first problem. Of course, the less sequential and more collaborative aspect of R&D is definitely a problem for for full cost delineations. And the problem that people usually face with R&D costs is that the full cost determination implies clearly multiple and significant allocations of costs. So if you think backwards and re-engineer this process to fit your nexus ratio, then if you don't do it in a semi-automated way, at the very least, you're going to lose track of information. And when we know that tax administrations are being actually quite demanding on the reporting for your nexus ratio benefits, it's certainly an area you need to secure. Product to market, I think this is the part that Michael is gonna show us. But product to market, I mean, the pharma is clearly what I call an intercompany sales multiplicator, because with the supply chain that many big pharma have, with the principal structures that are present in most companies, you'll always end up with intercompany sales that are higher than third-party sales. Now, the funny part of that, or the depressing part of it, depending on where you sit, is that you have probably a group of 7 people or 10 people max to deal with more sales than actually the full controlling teams. The large volumes of data in pharma is going to be a problem, but Michael will elaborate on this. Why? Because there's a tremendous amount of data articulation to be made. All the data is not coming from the same source, and it has to be properly articulated. The last part, which I'm quite sensitive to, is that actually product to market is a problem because it goes for TP purposes, to a clearly unnecessary level of granularity. You don't need for TP purposes to go to SKU levels. It's just a transactional constraint, but it's a heavy transactional constraint. And for customs, of course, the real one. Now, global support is probably the less fancy of them, but global support, I will start by the end. Typically, those calculations are made by pure organizational heroes. This is the person that is standing in the middle of your team or somebody else's team in controlling and doing everything. And if that person goes under the bus, it's over. You have to restart everything. So this is, for me, the way I've seen it, the least optimized process. It is an important one because we're talking about heavy numbers, and we're talking about fragmented teams and fragmented organizations that are global, but sitting probably in a tremendous amount of jurisdictions. And that's the simple equation: management center multiplied by legal entities equals chaos at the end of the day. So, and there's the last part is that, of course, these structures incorporate a tremendous amount of allocation keys, which again is a problem of data articulation. So in a nutshell, as you heard it probably several times, this is all about articulation. Articulation of these processes when it comes to the justification of profits in a principal, justification of profits in an IP owner structure. It's about teams and how do you want to deal with this, about systems and about data. And on systems and data, I mean, I have to recognize my limitations, and that's why Michael jumps in.
Perfect. Okay, so but before we get to the next section, I'd just like to try to launch a poll at this point. So let's see if this works. Yeah, so the question is, where does your organization stand today in terms of operational transfer pricing? Is it hero dependence, as Philippe was indicating? In other words, if there's one person and if that person leaves or cannot do the job for whatever reason, then you're sunk. Is it processes defined and owned by multiple functions within the organization? Is it centralized with global governance or already on the path of automation? And for those of you who are coming from an advisor background, or that's your current role, then please just give the average of your experience of your clients at this point.
Maybe we can move on and see to comment the result when we have it.
Yeah, absolutely. Well, I can see we got a good selection of votes right now, so I'm going to close it. And so where we got to is 22% hero dependence, which I'm sure you'll enjoy, Philippe. 26% processes defined and owned by multiple functions within the organization. 37% centralized with global governance, and 15% already on the path of automation. I don't know, Philippe, if that reflects your understanding or your experience of the organizations.
Yeah, I find the 22% hero dependency quite scary.
Quite possibly.
But not surprised. I mean, I think it reflects pretty much what I've seen, at least, within the industry.
Perfect. Cool. Okay, so before we go ahead and ask Michael to walk us through how automation can work in practice, I'd just like to give a bit of a background in terms of legal implementation of TP, and Philippe, feel free to jump in at any point if you say if you have any particular experiences in this area. And obviously the context is the environment has changed massively over the last 10 years, 15 years. So whereas before it was mainly about just having a TP report of some kind, possibly master files equivalents produced, and that may just get through. Now it's very different environment, as Philippe has mentioned, and legal agreements are just very easy for tax authorities to ask for. In fact, it's often one of the first things apparently that is asked for in tax audits. It doesn't require 100 different people to be interviewed, and it's very easy just to look at, well, what do the TP policies say on the one hand, what do the agreements say on the other? And if you have a mismatch like there was in Coca-Cola, then you are on the back foot, and it can be very difficult to recover your position. Then the other interesting development, including in the pharma sector, is the tendency from tax authorities to request quite heavy numbers of documents in terms of external agreements, third-party agreements. So an example was the Bayer case in Canada. So I think this was a TP audit in around about 2018, where the CRA was asking for third-party contracts for around about 2013, 2015, and asked for 50 individual different third-party contracts to provide reference points for the pricing. So the fact that organizations have to manage not only their internal agreements, but also how they relate to external agreements, obviously it's a huge burden. So I'm just going to go through the basics of legal implementation of intercompany agreements. And what it boils down to, the three key points are: number one, alignment; number two, stakeholders; and number three, audit readiness. I'll do this quite quickly, and obviously we have a large amount of free materials which are available if you'd like to know more about that. So alignment, what are we talking about here? So basically, this is saying that the agreements need to be aligned with the TP policies as regards to the key aspects, which are basically functions, who does what, the delineation of the arrangements, clearly the pricing. One of the criticisms in the Coca-Cola cases was that in many cases agreements had no pricing clauses at all, or the pricing clauses bore no relationship at all to the actual profit splits type model which was being adopted there. So pricing clauses. Third thing is allocation of risk. For a number of different transaction types, risk allocation is actually fundamental from an economic perspective to explain the transfer pricing from an economic perspective. And finally, ownership of intangibles, ownership of IP, and obviously Coca-Cola is another great example of where the agreements showed a position which was the opposite of what the TP policies were putting forward, and it made it very difficult, or is making it very difficult for the taxpayer to recover from that position of having basically shot itself in the foot. So that's what we're talking about in terms of alignment. One of the key things when it comes to alignment of risk is the point that risk only has a meaning if it's forward-looking, and this is something common to the TP OECD TP guidance, as well as IRS commentary and so on. And that means that in terms of the processes involved, agreements need to be put in place in advance on a prospective basis and not somehow after the event. So that's about alignment. Second key point is about stakeholders. And this is the point that intercompany agreements are not just some kind of administrative inconvenience that needs to be created for transfer pricing purposes. They also provide a key reference point for a number of other stakeholders, including VAT, customs, asset protection, IP protection, and so on. In fact, when I look at the kinds of jobs that we've done from a legal perspective in this field, a number of our engagements have not been TP focused at all. For example, in the cash pooling arrangements, it's been cases where the local directors have actually wanted a legal view on, is this an arrangement that is proper for them to approve and participate in, given the legal obligations of the directors and of the legal entities. So the key point here is, just like TP itself depends on data from a number of different sources, in the same way intercompany agreements and the process of creating and updating them needs to be done on a cross-functional basis, and that needs to be baked in. The final point I'd say is it's all about tax audit readiness. So from our perspective as lawyers, there is no point in us doing what we do and creating the most beautiful, aligned, easily read agreements if they are not available to be produced in response to TP audits when they happen. So this is all about being audit ready, and really the only way to do that is to centralize the process so that there is in some form a central archive of intercompany agreements which is maintained and kept up to date. And I think the reality is that a number of organizations, or most organizations, most groups, are in some form of transition in relation to the management of their agreements, and in a situation where a number of those agreements, perhaps all of those agreements, are managed in different pockets within the organization, and the issue is that the TP function may not have that central overview of what those agreements say and what they do and whether or not they are aligned with the TP policies. I don't know, Philippe, if you'd like to comment on your experiences of organizations that you've come across in terms of their agreements.
Well, don't talk to the pharma industry about Canada. They all have been summoned to produce third-party agreements, but there's clearly, I mean, the only thing I would add is in the industry, you know, the industry is characterized by tremendous patent litigation, and intercompany agreements can actually, in some cases, not be neutral. So that's where there's probably a increased importance in the entire stream of agreements between IP owners, principals, distributors, and manufacturers to secure these issues in terms of patent litigation, where to have quite interactions with legal.
Mm-hmm. Absolutely, and I would say that that's the number one challenge in agreements, is actually the general issue about alignment of legal ownership, economic ownership, because obviously the TP view of the world is not always the same as the legal view of the world and the regulatory view of the world. And because there is actually one truth there, which is who is the owner, it's just a question of creating sensible policies which are capable of being aligned and then documenting them appropriately. So I'd just like to launch a polling question on this subject, if I may. The question is, which of the following statements best describes the current status of your intercompany agreements? Is it you've got comprehensive, up-to-date agreements which are aligned with TP policies? Next option, we updated them 3 years ago, but we've fallen behind since, so haven't done much since then. Third one, ICA is not managed centrally, and so frankly we don't know what they say. Or is it the final one, we just create agreements when we need to respond to tax audits? So I can see we've got looks like we've got pretty clear results coming through. So 41% I would say is doing pretty well. In my experience, out of the clients that we work with or we come across, we speak to, most of them but very few of them have comprehensive, up-to-date and aligned agreements. So well done for everyone who's in that category. 23% updated them 3 years ago. 18% not managed centrally, so we don't know. The final 18%, we create them as and when needed to respond to audits. I don't know what you think, Philippe, but this is becoming almost impossible to do now because it's just so hard to retrofit something in a sort of emergency situation that is not going to shoot yourself in the other foot.
Yeah, well, I think the industry had this debate for I mean, not this industry, but everybody had this debate. What is better, to have an agreement that is qualified as poor, or probably not substantial enough, or no agreement at all?
Mm.
And for a long time, the answer was probably, well, no agreement at all is better until I'm asked for one. And now, of course, documentation requirements have changed, and all the entire notion of control over risks is pushing for, let's say, more developed agreements. So that's probably not sustainable over time.
Yeah, cool. Great. Well, I'd like to hand over to Michael, please, for the technical part of this session in terms of automation. So please walk us through it.
Yeah, thanks, guys. It's really interesting stuff. I'm glad I only have to worry about the technical bit, the kind of IT technical bit, and not the intercompany agreements. Philippe, I just made a couple of comments on some of the stuff you mentioned. So, I mean, first of all, in the first polling question, I think it's really interesting that 22% came back. What phrase did you use, Philippe? Hero dependency, was it?
Yeah.
Hero dependency. Yeah, I'd be really interested to see how much that's skewed towards, you know, R&D, IP box, Nexus fraction type stuff. Because I'm neck deep in that at the moment, and it's a real challenge. One of the challenges that I noted on it as you were speaking was the fact that for some of this R&D data, it might be 4 years down the line when I could look at some R&D spend and actually attribute that to a brand, you know, and a saleable product. So there's that challenge, as well as all the ones you listed. But anyway, so I could talk at that, talk about that for hours, but I won't. So what I'll take people through is just maybe from an IT kind of systems perspective, what any sort of solution around automation of transfer pricing might look like. So there's a few kind of layers in the systems and the data to think about. We've got our source systems, we've got our general ledger systems, where, you know, we have the challenge of basically, you know, loading a P&L for every legal entity in the group. You know, that's a good starting point for this. So large data volumes coming out of there. We'll have commercial forecasts as well in the demo that we'll look at today. Focuses quite heavily on making use of these commercial forecasts. They're not always perfect, but, you know, typically we'll have some commercial forecasts which give us, you know, revenue and volumes and maybe some marketing spend. Maybe it doesn't have any of the intercompany kind of, you know, forecasting at all, but it's at least got, you know, our external sales, and we can use that as a starting point. We'll have systems for our HR data and timesheet data, you know, particularly for R&D. This is going to be, particularly for R&D, this is going to be useful, and hopefully, you know, we're capturing data there, which is useful for our R&D calculations. And then Philippe, I think you mentioned master data and the importance of this at the beginning. We'll need master data, or, you know, reference data for lots of different things, not least products. You know, so if I think about one of the organizations I'm working at the moment, they've probably got 30,000 individual kind of SKUs when you look across all of their finished pack SKUs in the different markets, all the different versions of these that really represent the same thing, but, you know, in one company's books compared to another company's books. And then you've got, you know, SKUs for ingredients and API and these types of things. So we'll have large amounts of reference data around that. We don't always necessarily interact maybe directly with these systems when we're pulling data into our OTP solution. If we're in the situation where we have 8 SAP instances globally, for example, which is probably not uncommon, or we've acquired some companies and we have multiple ERP systems, then we might have the luxury of having things like data lakes or data warehouses, finance data warehouses, which collate all this data for us. Philippe's smiling, so I don't know if he's been through some pain with this sort of stuff before, but there may be some sources there, you know, which provide data to external reporting systems, for example, which we ourselves could utilize in terms of data feeds into any type of OTP solution that we create. We'll probably have data warehouses as well, specifically around HR, specifically around R&D, which will maybe give us some of the granular detail that we need in cost allocations, for example, for those recharges. And then we've got our external reporting systems as well. Sometimes these can be a data source for OTP, and sometimes they're a reconciliation point. We'll be definitely be doing something with them. If I think about the systems I'm working with right now, we have some reconciliation points with our external reporting systems, but we also take some intercompany data, so some breakdowns of intercompany from there, because it's the appropriate, it's the most reliable place to go for that. So we'll have these data sources that we're integrating with, and typically, you know, the integration is going to be big and complicated enough that on the OTP side, we require some sort of integration and data cleansing part of the overall solution. So this is the sort of thing I spend my day doing, is worrying about this type of integration. We're then into the OTP application itself. So I'll be showing you an Oracle-based solution. It's built in a product called Oracle Planning and Budgeting Cloud, which is a big calculation engine and reporting engine which you can use for transfer pricing. There's another product as well called Profitability and Cost Management, which is very much focused around what it says on the tin, cost allocations, and very flexible cost allocations with lots of detail of the lineage of the inputs and outputs into different kind of cost allocation stages. So there'll be some sort of front-end application like that where we're reviewing data, we're entering markups, where we're usually dealing with references, internal versus external spend, these types of things. We're running allocations, and then the example that we'll look at is setting prices. So Paul, if you could flick to the next slide. I'm going to talk quickly just through a very quick demo we're kind of going to look at today. The demo is all around the process I mentioned, where we look forward to next year, and we use our forecasts that we have to set prices per SKU. I mentioned that large number of SKUs that we've got, potentially to deal with, many thousands. In my experience, this is typically a few thousand SKUs that we need to set prices for individually. If we're thinking about finished pack SKUs going between, marketing companies and their related party suppliers, this might be a few thousand SKUs, in my opinion, that we've got to set prices for per year. So the scenario that we're going to look at is we've got a US-based legal entity performs both sales, marketing, distribution activities and R&D activities. We'll be focusing on sales, marketing, distribution for this. And we want to set these prices between this legal entity and its related party suppliers. Starting point for this is going to be a profit and loss accounts, so our forecast P&L for each legal entity loaded from our commercial forecasting system. This commercial forecast will include revenue, volumes, and marketing spend. So the revenue and the volumes will be kind of per SKU, and the marketing spend will just be an overhead that needs allocating. So the simple process we're going to look at in the system is just reviewing this data that's been loaded from the forecasting system, entering some adjustments, and I'm keeping this very vague, but this could be to cater for IFRS versus tax standards, or it could be to plug some gaps in the commercial forecasts, for example. Configuring some cost allocations, running those cost allocations to allocate marketing spend down to an SKU level, and then going through a process where we set prices per SKU. And you can see basically a profit, an operating profit per SKU at that point, and also see that at a brand level, at an IP owner level, and for the US legal entity in this case, see that for the whole legal entity. Some complexities which we won't be diving into in this demo, but I just want to make note of, which I've come across in the pharma industry. So I'm assuming some P&L segmentation's already occurred here. I've mentioned sales, marketing, distribution versus R&D, and I'm assuming that I can automatically perform that segmentation as data is loaded into the OTP system. I can do that. There's usually a need to perform some sort of adjustments or sanity checks once it's loaded in, but we'll be skipping over that in the demo. We've also, we're focusing on finished pack here. There's also, supplier to supplier transactions. There's transactions around API, for example, and bulk. We'll be skipping over those, but I wanted to acknowledge the complexities around those. Usually data sourcing for those is harder than data sourcing for finished pack, so that can be quite challenging. Then there's some of the mathematics we just need to do around stock revaluation, import duties as well, which I deal with on a day-to-day basis. We'll skip over in the demo. I'll also be skipping over where we get things like our supply chain reference data, because I find that quite difficult usually. Getting reference data around the physical flows of goods and also the financial flows, especially Philippe, you mentioned, I think at some point, kind of multi stages, multiple stages in the supply chain. It's sometimes easy enough to look at some intercompany invoices and derive the supply chain if there's only two companies involved. But once it gets more complicated than that, it's very difficult to marry it all up. And then things as well, like, you know, getting these prices out of the system and loaded back into the ERP systems, we'll skip over that. And we got some additional demos there, which I'll just let you take a look at. If we want to get into complexities of IP box and this sort of thing, we probably need a different session on that, so we'll skip over that one. So Paul, if you could flick to the next slide, thank you very much. I'll keep this as quick as I can. What I'm doing is I'm jumping right to the very end of the demo here. So spoiler alert. This is what we this is what we want to end up with at the end of the process, right? And there's a whole bunch of you know, data integration and allocations required to get us to this place. What I'm doing is I'm looking at a form in this system which I've configured. And I'm looking at the sales and marketing kind of transfer pricing function here. And I'm looking ahead to FY22. And down the left-hand side, I've got all my different SKUs rolling up into brands, rolling up into IP owners. And then from left to right, I've got my my profit per SKU post allocations of the marketing spend. Okay, then I've got my current transfer prices, so I can see what these things are currently trading at. And then the system has suggested to me a transfer price that I could set for this individual SKU to get the return on sales for that SKU to within a target range. I've then got a column where I've entered that, so I've actually chosen what is my new transfer price for this individual pack going to be. And then I've got my volumes that are in the system. Multiply those two things together, obviously, and I'm going to get my intercompany cost of goods sold for this US kind of marketing company that we're dealing with. With that calculated intercompany cost of goods sold, I can see what is my operating profit now, basically for this SKU, or what am I forecasting that to be. And I can see the return on sales and see whether that's within a target range or not. So this is, you know, one of the things is like kind of different in the pharma industry to some of the other industries I've worked in. Other industries I've worked in, it's been a lot around cost allocations, but it's a lot around services and less around products. This is the level of granularity we need to get to, obviously, on the distribution side of what we do in pharma. And it involves getting down to that individual SKU level, allocating down to an SKU level, and setting prices per SKU. Now, to the extent that this can be automated, obviously, you know, we're suggesting a price per SKU here to get us to a target return on sales, so that could be fully automated. We do tend to give a bit of flexibility around this, obviously, and let people do some manual setting if they want as well. We have situations, Philippe, I don't know if you've had to deal with this one before, but things like looking for consistency across different SKUs of the same, you know, same active ingredient, basically. Mm-hmm. You know, and you want to extrapolate, so you've got a base cost, you know, per unit of active ingredient. You know, and I forgot something that's 24 micrograms or whatever I've got in my example here, right? That's twice the price of something that's 12 micrograms and that type of thing. So, and that's another kind of challenge, I guess, around sourcing data is that type of reference data as well, around pack sizes and pack types and these types of things as well. So in the interest of time, Paul, if we flick to the next slide, I'm going to skip past a couple of these. So this is me entering data kind of per SKU and entering some marketing spend. If we skip past that one, I'm going to get onto the point where when we skip ahead a few more times, I'm going to get to one more. I'm going to get to the point where, here we go. So this is, I'm going to show just how we get to that final stage. So how we get to the point where we're setting prices per SKU. And I'm going to look at kind of reviewing data here, configuring some cost allocations, running the cost allocations, and then getting to that final form where we can do price setting. So this is the sort of form in an OTP system we could be looking at before I run any allocations. I could be looking at basically my P&L for this legal entity that we're playing with here. I can split that by product. So we've got product at the top there. I can drill into that and see IP owners and brands and SKUs. So I can see my costs and my revenue kind of per product. I can also see that by transfer pricing function. So I've got the split of sales and marketing and R&D there. Obviously, this is using the P&L segmentation, which will have already occurred by this point. And then I've got another axis by which I can split this, which is my, I'd call it something like a data view or a process stage, this type of thing, where I've got my loaded data versus my adjustments, and then that all summing up to my position pre-allocations. I've got my accounts down the left-hand side as well. And what we're going to do in the next stage is take this position, which I've called pre-allocation to SKU, take that number and allocate the marketing spend out across SKUs. So Paul, if you flick to the next screen, this is where we just do some configuration and we use some of the flexibility in the system. So I've got a pretty simple allocation here. I mean, I just want to take my marketing spend and allocate it to SKUs within the legal entity. So it's not multiple allocation stages. You know, sometimes we have to worry about things like, what if my net sales, you know, value is a debit value, and do I need to exclude it? You know, that type of thing. But here we're just going to say we're choosing net product sales there as our allocation driver, and I'm going to use a target of 5% when I come to my price setting. So my return on sales at the end should end up as 5% per product. So Paul, if you skip to the next one. So this is the type of screen I could then use in the system to review the cost allocation. So when I clicked save on the previous form, that actually, you know, configured the cost allocation, actually ran it as well, and then presented with this kind of view of the world. So I've got all my SKUs down the left-hand side, and there's also one called no product, which is where my marketing spend would land. And the columns give me basically my loaded data, you know, my adjustments, the sum of those two in the third column. And then when I run the cost allocation, the credits and debits generated by that can be seen in that fourth column. So it's all net zero, clearly. Something's gone wrong if it's not. But here I've got some cost that was originally against no product. I've now got a big credit against that to balance that to zero. And then I've got my debits across all my products here. So we can present this type of view to show, you know, the history of allocations, you know, where some of these numbers came from. And obviously, if we had a multi-stage allocation, this would look a bit more complicated as well. But fundamentally, we'd be able to see the inputs and the outputs to every stage, as well as the allocation drivers themselves. In this case, we're allocating based on net sales, which we could report on anyway. But if we were allocating based on headcount and, you know, maybe for some IT costs or something like that, then we could see all that in the system as well. So Paul, if you flick to the next slide, then that's it. We're back to the beginning. But we're back to the beginning, which is the price setting, and what we've done is just explain basically how we arrived at that first column, which was the, you know, profit per SKU, before we actually go and then set some prices. So very simple demo, very simple, overly simplified use case, definitely for pharma, but hopefully kind of inspires some conversation.
Fantastic, thank you, Michael.
I think, if I may, just for a second, I mean, the beauty of the tools when they're developed by EPM professionals versus stack professionals is that actually they do respond to a need. This is typically what you would have, you know, when you have a rollout of SAP for HANA, where you would basically try to achieve a P&L by SKU. A lot of people say, well, why? The beauty of that, which is what the tool does, is that it allows you to aggregate and disaggregate data as you want, without altering all the architecture of the data. That might sound a little bit brutal, but actually it just gives you the flexibility with the traceability, which is the permanent problem that we're all after. Sorry, Paul, for interrupting.
Oh, no. So I can see we've got about 8 minutes left, and I've got some questions for you, Michael, if that's okay, and Philippe, if you want to comment as well. So what first question was, can your tool accommodate multiple policy exceptions?
Yeah, so I mean, maybe Philippe can jump in around, I suppose, the technical definition of policy exceptions here. But in terms of different transfer pricing methods, yes, absolutely. You know, different types of recharges, you know, typically require different types of methods. So I'm showing a return on sales, you know, return on sales kind of method here. We'll have, you know, different functions, or, you know, manufacturing where we apply cost plus. And even when we do things like on an individual SKU level here, I actually have examples where, in the current company I'm working for, where we would flag individual SKUs actually as to be set on a cost plus basis instead. So, you know, doing 80% of this is really easy, but handling the, you know, the exceptions is where a lot of the effort is. So yes, it generally helps to build in flexibility, where even if the system doesn't have some clever functionality to handle an exception, we have the ability to put adjustments into the system at certain places to handle these things. And when it comes to, you know, year end, that's probably a better route to go down, rather than doing an IT project to change the code. So that's the way I try to build it, is, you know, the ability to cater for adjustments at various phases of the allocations.
Said differently, it does allow for it does accommodate all policies in terms of both methods and metrics, which I think is the two definitions of policies themselves. Cool.
Okay. Next question was, automation tools can operate like a black box in terms of allocations. So the question is, how can you ensure traceability as part of your tool?
Yeah, hopefully the demo, although it's very, very simple, hopefully it shows a little bit of that traceability where we can see the inputs and outputs into the allocation stages. It does get a little bit tricky where if you run some allocations all the way down to SKU level and you have quite complex logic down to the SKU level. So I touched on this point about, if you've got a debit balance on the SKU in terms of its net sales, don't use that to allocate costs. Some of these things, if you did them outside of a system and then tried to reconcile a high-level report, I think you'd really struggle. So the system helps with this, helps with just the data volumes and that sort of thing. Generally, the rule is show all the inputs and outputs into the allocations, and don't do anything in terms of allocations. Don't do anything outside of this, kind of user interface, which I'm referring to here. I don't want to get into horror stories about previous systems I've seen, right? But I've seen one before where cost allocations were running in that kind of integration layer, which I kind of showed on the high-level architecture diagram. So the first thing transfer pricing manager would see when they logged in was some allocated costs, right? Clearly that's no good, right? Clearly that's no good. So it's don't do that. Just load in the actuals, the forecasts, kind of unmanipulated and certainly without any cost allocations having been run, and then just show all the inputs and outputs for all the allocation stages in the system.
I mean, if I may add just one thing there is, all this is about layering data, layering allocations. The reference to the black box there comes probably because some of the tools out there just provide you, I mean, they ask you for the input and they give you the output. The nice thing that I find about this is that actually you have full visibility on all the intermediate steps, which is something that you would do, in different Excel spreadsheets, technically, but with the automation, it just ensures absolute consistency. And of course the capacity to basically address large volumes. So that I think is the main difference between, let's say, like it's as if you had a documentation tool that explains you exactly what is done instead of just providing you a PDF.
Mm-hmm. Cool. I can see we just had an additional question, which I think is directed mainly at you, Philippe. And the question is, apart from setting up transfer prices and putting in place intercompany agreements, what are the other dimensions of OTP, operational transfer pricing? I guess we're talking about the life cycle here, Philippe.
Yeah, well, there's virtually no limitation there, other than the entire life cycle of transfer pricing, which is, of course, documentation. So there's, I think that's a very tricky question because you define your OTP based on your needs and based on your tools and based on your organization. So there's the mission that it's, for me, it's the starting point of an automation project, which is to clearly define the mission of OTP. So I mean, responding to that question in a straightforward manner actually would tend to be a mistake because it all depends on what you're after. I would tend to believe that in big pharma companies, you need to have an operational transfer pricing team that is able to interact from both the supply chain aspects to the OTP price setting services, documentation, updated agreements. There's basically no limitation again to what you can do because OTP goes well beyond TP and tax. So you can really basically articulate that function with different cubes. It really depends on, and it doesn't need to be a one-shot approach. It can be also a progressive approach.
Yeah. And I think obviously the overarching theme of governance is really key here, and that's both from a sort of transfer pricing perspective. Tax administrations like the ATO Australia Justified Trust Program. It's not just about the output; it's about the confidence in the overall processes which led to that output. And from a legal perspective, governance is so key, and it's basically about respecting the fact that there are separate legal entities, and even though many organizations may not naturally manage themselves on a legal entity basis because it's line of business, in fact there are individual legal entities, individual directors with legal responsibilities, and therefore the whole process of setting TP policies, adjusting policies, implementing them as you go along requires governance in the sense of informed consent from the participants, and that requires extra dimension of work, which means it's really only possible to do that by streamlining the arrangements as much as possible.
I mean, look at it this way. When it comes to automation in the industry, well, you think you have the choice now whether you want to embark on automation or not. Actually, well, you might not have that much choice. Cost compression, more workload, and enhanced systems is the right answer, probably to describe the framework. But if you bring the elephant in the room here, which is pillar 1, or whatever comes out of pillar 1, then you realize that actually there's no option at all. So because pillar 1 will require such a high level of data reconciliation that, I mean, in my view, it's not possible to manage that other than with an automated tool.
Cool. Well, on that note, I can see we are exactly up to time, so I'm afraid we'll have to leave to one side the other questions that we would have wanted to go through here. I'd just like to say thank you very much to Michael for spending the time to walk through how this can work with us. Thank you very much to Philippe for giving us the overview and the insider's view of what it feels like to some extent, and especially thank you to everyone who has participated today, and we would love to continue the conversation. So if anyone has any additional questions which we haven't been able to answer, please do reach out, and in addition we will get in touch if that's okay, and ask if there are specific subjects that you'd like us to cover in future webinars, such as specifically focusing on R&D arrangements or whatever. So with that, I'll say thank you very much again, and that ends this webinar. Thank you.
Thank you, Paul.
Thank you, Paul. Thanks for
Michael.
having me. Thanks, Philippe.